Good evening, everyone, and welcome from historic Durango Main Street at Fort Lewis College's Center for Innovation. We have our most recent installment of the Hawk Tank Business Plan Competition Workshop Series. We once again have Mr. Gary Masner from the Southwest Colorado Accelerator Program for Entrepreneurs joining us, and will be leading tonight's discussion on financial projections. As a special added treat, we will also have Beta Alpha Psi joining us, Fort Lewis College's Beta Alpha Psi joining us. And Beta Alpha Psi is a national honor society focusing on finance and accounting. So it truly is our top finance, and they are here today to support you, Hawk Tank participants, and support you in understanding sort of how the financial modeling works and really take you to that next level. At the conclusion of tonight's live stream on Facebook, we'll be migrating over to Zoom for a working session, and this is your opportunity to connect with Beta Alpha Psi and get a consultant to help you with your business idea. Without any further ado, Mr. Gary Masner, thank you.
Thank you, Dr. Valdez. Hello, everyone. So today, again, we're going to be talking about financial projections, and you've been spending now your time trying to get details into your business model that you're doing, thinking about what it's going to cost to do, to create, and then go out and market your product or services, thought about what you need in terms of operating support, personnel, things like that. So today, what we're going to talk about is how you take some of those thoughts and translate them into actual financial numbers, financial projections, and really end up trying to decide whether this business model, this idea you've come up with, is really scalable. Can you get it to a point where it's generating positive cash flow, which we'll focus on, and what it's going to take to get you there. So that's what the process is. What you'll see is that we're going to go through and talk about all of the numbers that you need, and then as Dr. Valdez said, you're going to have really great support from the Beta Alpha Psi advisors, and then you're going to have these models that we've tried to make it as simple as possible to put down some assumptions, fill in some numbers, and really come up with what kind of capital is going to be required to build your company and potentially how much it's worth for going through all that effort. So we'll start out today's session. Making financial projections, and again, the term you might hear from many of the financial advisors and finance and accounting people are pro formas. That just means projections, right? They're not historical financial statements, they're your pro forma projections. And again, what we've hoped through this whole process is you're going to learn a lot. You're going to learn what it takes to hopefully compete and win in this competition. But you're also going to gain some knowledge and understanding and hopefully skills that are going to help you throughout your career, whatever that might be. And I guarantee you that whatever it is, if you're running an engineering department someday, you're going to have to be making annual budgets and things. So it's an important skill to get, it's important understanding, but it has some very specific use throughout that thing. So you're looking at it in your business model. If you're in a company and you're thinking about starting some whole new project or whole new division or going after some new product markets, you've got to put together a business model. You've got to figure out, is it really a viable business idea? Obviously, when you're selling to stock to investors, they're going to want to see some pretty long-term financial projections. When you're approaching a bank, they want to see financial projections too. They want to understand that you've got a reasonable prospect for paying back their loans and stuff. Annual plans and budgeting, every company does it. You'll be involved in that for sure in your career. And then obviously, whenever any company's running short of cash, you start really condensing down and figuring out how we're going to survive and how we're going to generate some cash and control how we use it and stuff. So for the things that we're talking about today, for the business plan competition, and for some of the longer term things, whether it's looking at at new business opportunities, looking at a new division in your company, or doing the kinds of things where you're selling stock or doing things in the future like that. We're talking about a 3 to 5 year set of projections, breaking it down in the initial stages to kind of quarterly projections so that you can just see how it's building up in terms of spending and things, and then after that annual for another 3 to 4 years to get a total of a 5-year set of projections. So it's a step-by-step process, right? It's not, there's no way just to snap your fingers and to get it done. You're really talking about a lot of variables in this process, just like there are a lot of variables in thinking through the whole business model canvas, thinking through your marketing plans, thinking through all that. So you've got to have a lot of that. You're going to make a lot of assumptions to fill in almost any number, and it's really important to document those assumptions, and you'll see that the model has lots of room for you to put those in for almost any individual number that you build into the model. And it's important because you want to go back and review those and understand, well, where did that number come from? And is it right? And should I make some changes and see what impact that has on my total cash flow needs? You're going to be talking both about income statements, profit and loss statements, often called, where you're looking at your revenue and your expenses and seeing what the bottom line looks like. But you're also going to be looking at the balance sheet, which is where you show things that don't come into your P&L. For instance, you're buying equipment or computers or furniture, a capital asset purchase. That gets put on your balance sheet, and then a piece of it every year through depreciation gets shown into your P&L. So you're going to have those. We're going to leave out cash. We're going to leave out. You're going to need cash to fund all this. But that's what you're trying to determine. How much cash do I need? What's my total cash burn going to be? We'll get into some of those descriptions and defining them later on. But you really need to know that. How much capital do I need to build this company until I turn cash flow positive? That is, I'm creating a positive cash flow in any kind of month or a quarter or year and stuff. And that total you need, that's what you've got to raise, either from loans or stock sales to really finance the company until it becomes self-sustaining, cash flow positive. So we're going to end up with a whole set of these items. We're going to be talking about them. And again, I just have to emphasize, really try to document the assumptions you put in to support this, so you can really explain it to people. You can talk to people about it. You can talk to your Beta Alpha Psi teammates and really, say, does this make sense? Does it seem realistic? So we start. Yes, Professor Valdez.
Real quickly, everyone, please really think about those assumptions. Mr. Masner, we've talked about this quite a bit, right? We talked about it in terms of, trying to figure out who your market is. Your defending of the assumptions is really the gold. And that's really where the judges are looking to differentiate and try to understand if you can actually do what you're saying. Exactly. And so please leverage Beta Alpha Psi. As accountants, this is a big part of what they do, is sort of, they go and they have these assumptions on how they sort of do their accounting. And so please lean on Beta Alpha Psi, and they can really help you with those assumptions. And of course, I'm here also to help you, but those assumptions are critical to your success.
Exactly. Couldn't have said it better.
Oh.
And as a matter of fact, see this little line here on every slide that says, don't be overly optimistic.
Yeah,
okay?
No kidding.
Show the judges, show anybody, in any kind of setting you're going to be in your career, whether it's the management that you're pitching an idea to, a bank that you're trying to get a loan from, stock investors, you're trying to get them to buy stock, buy shares in the company. They really want to have that sense that you're realistic, you're grounded. Yes, you've got some reaching kind of goals and things, but you've thought them through, you've thought through what it's going to take, and you're really ready to kind of make it happen. So totally crucial, and very crucial, as Dr. Valdez said, to convince the judges that you've really thought it through and you've got a plan that deserves winning the competition. So we're going to start with revenue. That's where it all starts. We've said that before, and I think when we were talking through making sales projections in the last session, we said do it by units, okay? Don't do it by just solid dollars. Do it by units, then you can add a per unit price, per unit revenue achieved, and it's just a lot cleaner way to think through and really be able to look at, can I really grow my unit sales from A to 3 times A in 2 months? No, but what's a realistic assumption there? So do that. We're going to again set targets by quarter for the first year, then annually for 4 more years to get a total of 5 years. It's really important to not just have an overall one for the company. If you've got multiple products or multiple channels, make sure you make a revenue assumption for each of those products if they're discrete products, and even if it's one product going through multiple channels. Maybe you're selling some direct to consumers, some through retail chains, or you're selling to a combination, some to very large customers that are going to be able to negotiate a lower price, a bigger discount from you versus smaller customers. Show how many large customers you're going to get, how many small customers. Think through what's going to differentiate the business, the pricing, the returns, the cost of reaching them, and really make your assumptions against each of those each of those segments.
So, Mr. Masner, we have a question from Zeb, and his question is, if your idea is a business that provides services, would you set targets based on labor hours rather than unit sales?
Yes. So it depends on what the services are. It's a good question. If you're in the consulting business, then what you're going to have is you're going to sell various sized projects. I started out at McKinsey right after business school. So yeah, we go and we work with a company for 3 or 4 months, 3 or 4 of us typically. So yes, you're going to have again, they could be different sized ones. You could have some for large customers, some for smaller ones, and you're going to. And so it depends. If it's that kind of a thing, a project oriented thing, then I'd say no. Put a price on the project, and then your cost picture, which we'll get at. There you'd put in your hours of people doing it. If you're in the kind of business where you're really selling yourself by the hour, you're an accountant, you're a lawyer, you're a masseuse, I don't know what it is, but any of those kinds of things, then say, okay, I'm going to be out there and I'm going to be selling X hours of my time per year at this kind of a price per year, or I'm going to have multiple people doing that in my firm that I'm starting. So it all depends. And you'll see that, and you'll see when you look at the model what seems to make more sense to you. Great. And again, you'll get input and advice from the Beta Alpha Psi people, from Dr. Valdez. If there are any things that he wants my input on, believe me, he'll reach out to me for sure, and I'll be happy to give my 2 cents worth in that for sure. So, but very good question. Okay, and you're going to see some things, and as a matter of fact, we'll get to it in a minute. But besides the product thing, we do have. The model does have the ability, if you're selling a subscription or a licensing kind of a thing where you've got, recurring revenue that you're getting, we've got a model that reflects that kind of a business model in your revenue projections. So there's a couple of different ones that you can use that really help you kind of streamline the whole projections part of it. So again, we're going to start, so that's the discrete part. We're going to start calling it gross revenue. And again, QuickBooks all of a sudden seems to like to call revenue income. And I never have understood that. It's not income. Income is what you have after you've incurred some expenses. I like to call it revenue. We're going to call this gross revenue. So that's, you're selling, depending on what you're doing, you're selling at gross revenue. You may give some discounts. There may be some other things. You may have to pay a commission if you're going through some sort of a distribution group, a sales group or something. So, but you start with that, and then you put in your discounts that you're giving to customers or different channel partners to come out with a net revenue. You can ignore sales tax, of course. That's just something, if you're taxable like that, you're collecting it from your customer and then remitting it to whatever jurisdiction you owe it to. You're going to have some changes in the first year from quarter to quarter, then from year to year, and you've just got to make sure that they seem reasonable. As as Dr. Valdez said, you can't just say I'm going to grow 5 times, grow 500% every year. That just doesn't happen. Okay, 100% every year is almost impossible. But put down something you can really back up and say, yes, I've got a big enough market to achieve that. I've got the support. I've got a unique enough product and service. Just back it up with reasonable assumptions, and be realistic. And then once you're realistic, once you've got this model, we're going to tell you, then go back and cut what you already think is realistic in half. And that's your conservative model that you're going to use internally. You're going to look at it. It may not be, it's not what you present to investors or to the judging panel here, but you ought to look at it and say, hey, even if I've been overly optimistic, even if I only achieve half of what I thought I could get in terms of revenue, this business still can be successful. I can scale it with an achievable amount of capital I can raise and end up creating a very valuable company. So important to be able to do that. Don't, in this thing, if you've got an adjacent market that you can get into in year 2 or 3, fine, say that. But if you've got a whole new product, don't try to put it in yet in this model. Describe it in your description in your business presentation to investors or judges. But say, here's some additional products we think we can do, but we're going to focus first on achieving profitability, cash flow positive results out of our current products and our current markets.
I think it's really important, Mr. Masner, and I think this, once again, in a lot of respects, you're reinforcing what you've already said. And if the Hawk Tank participants can remember the last workshop we had in marketing and market analysis, was you really focused on narrowing down who your customers are, really trying to understand, when you talked about business model canvas, your customer segments. Why? Because you're not going to have tons of resources to serve everyone or to sell everything. And so just remember, Hawk Tank participants, we want to be as focused as possible to really create the most value for those sort of first movers, right? For those individuals that are really going to embrace your product or service. And then once you perfect that, or once you sort of get that momentum, maybe it takes 2 or 3 years, then you can think about these additional markets, these new products, how you can integrate and sell up, what have you. But really heed Mr. Masner's warning. That focus is going to be really important to your success. And once again, I think that's really critical, that we don't ignore where we see the growth and where you want to scale, but just really be that conservative and focus on what you do best.
Totally true. That focus is absolutely crucial to your potential success. And you've just got to stay focused. You're going to, people will come up with new ideas for you, whether it's people that are working for you, some customers might, but stay focused. The people that stay focused have the best chance of building a successful company, and it's crucial. You lose that, I've seen it.
Sure.
I've seen it here. The company I was on the board of, they had a great idea 10 or 12 years ago, got off to a great start, but then he got very unfocused and tried 3 or 4 different things, just lost it, and essentially in the end had to sell it for a lot less than it was worth. So,
thank you.
Okay. So that's our revenue. Now we start on the cost side. Every business has costs, unfortunately. It'd be nice to have one that didn't. But so the first one you do is what's called cost of goods sold. That's the old terminology when we were in a total product market. You can call it cost of sales or cost of revenue if you're in more of a service or software kind of a business. But it's the cost of really providing the direct costs of every single sale you make of a product. So it's what it costs you to produce that product, get it ready, get it out to the customer, support it while he's using it. It's all of those costs that are involved in it, and some of the sort of side ones in terms of selling the product potentially too. But it's definitely all of those costs. So obviously, if you've got a product, it's labor and materials, it's your factory or assembly, you rent and utilities, shipping and warehousing that costs you for a product. If you've got sales, commissions, either for your own people or for your channels that you're selling through, put that in here as a cost. The really smart people put in, if you're selling and taking credit cards and you're paying merchant fees of 2.5%, put that in here. I see a lot of people put it in general and administrative costs, which we'll talk about later, but it's a fundamental cost. Every time you sell a product and take a credit card payment, you're going to pay 2 to 3% of that revenue to the card payment processor. So put those in. If you've got a software product and you've got that on a cloud server, you're selling it through the cloud, you've got servers that are housing that information and software for you and your customers, and then customer support, right? If selling it, if you've got to get a customer onboarded, you've got to help them through the process of getting, being able to utilize and use the system, answering their questions, providing ongoing support. That is directly a cost of selling that product, and the more of it you sell, the more it's those are going to be directly proportional to your unit sales. So that's the first one. And again, it's called cost of goods sold or cost of sales. Show it on a per unit basis. Again, like everything we've said, you don't want to say it's related to revenue. It's related to that unit, whether it's hours of consulting you're doing or a product you're selling. But really tie those costs into your unit sales and stuff. And you'll see it change over time. We'll talk about that a little bit more in a minute. And then separately, show things that aren't directly proportional, like material would be if you're making a product, that it's a more fixed kind of a nature. So it's the factory space, it's the equipment that builds the product that you have. It's your warehousing costs. It's all of those things that, yes, you have to have it. It's a cost of goods sold. You couldn't sell without it, but it has a more fixed nature. And the model helps you kind of grow those, but not directly proportionally to your unit sales. So you'll see that and you go through it.
So just for some of those unfamiliar with some of the terminology, what Mr. Masner was just going through were fixed versus variable costs. And the way I like to remember this is the fixed costs are those costs you have to pay no matter if you sell anything at all, right? If you have a factory, you're gonna have to pay for that factory if you produce one product or if you produce 1 million products. And so that's why it's fixed. But let's say, for example,
the fixed side, they're fixed up to a certain level of capacity, right? You can build so many units in a certain factory with a certain amount of equipment. When you exceed that, then you got to add on some more fixed costs, add on some more of those. Sure. So fixed over a period, but it's a really good way to think about variable for each unit you sell, and then some sort of component of fixed. Good. So thanks for that.
Great, thank you.
Okay, so once you then, you really, what you'll see is that, and again, with a product, we said this a little bit before, but if you're selling a product early on, your costs per unit of sale are going to be higher. It costs you more to produce it. And the material costs more even because you're not able to buy it in big enough quantities to get the best pricing from your suppliers. You haven't honed in yet on your production process. So it's a little bit, you're going to get better over time. You're going to add some equipment that helps you produce it better, faster, with less defects and less waste and things. So over time, you'll scale up. You'll be able to bring those unit costs, the unit variable costs, especially for your product down. And it's okay to do that and show that, okay? Other kind of companies are going to have more fixed kind of cost of goods because, especially in the software business, once you've produced a product, a piece of software, then you can sell it, and it essentially has the same selling costs or the cost of providing it to your customers and stuff. So those will be a little more fixed in nature in terms of the total unit cost per sale. They won't unit cost of goods. They won't go down as much as product ones would. So when you subtract then this cost of goods from your revenue, you come to the first kind of important metric that's talked about and can be compared across companies and things, and that's called gross profit. When it's a dollar amount, you call it gross profit. When it's a percentage of revenue, That's how a lot of these things are going to be measured as we go down through them on the cost side, and then on the margins, which is what you get after you've subtracted out costs. That's called gross margin and stuff. So it's gross profit dollars as a percentage of your revenue. And again, you should, it may not be as high as it's going to be, but you should have pretty darn close to positive gross profits, or the pathway to get there pretty quickly in all of your products, or you're just not going to have a successful company that you can scale up.
So Mr. Masner, I've reviewed a lot of business plans. I know you've done way more than I have. I find a lot of Hawk Tank participants and even entrepreneurs, they have this tendency, or they want to, like, oh, I'm going to break even that first quarter, and then the second quarter, man, I'm going to make so much money. And for me, it's almost like a red flag. Like,
exactly.
There's no way you're going to make money in that first quarter. Why? Because you have to educate the market. Why? There's all these other reasons, right? And so how, you've done this for a while. You've done this, large scale. Can you share with the students sort of, your experience on sort of, and I know there's not one size fit all, but, can students sort of go profitable the third quarter, the fourth quarter? What is your recommendation for that? I know the recommendation is, be conservative. The recommendation is, quote unquote, be honest. But what kind of guidance? So, our Hawk Tank participants, if they're running the numbers, with beta alpha psi, and they see they're not going to be profitable until the third quarter or second quarter, that it's okay.
Sure, it's even okay if you're not going to be profitable until the third year of this.
Okay.
And believe me, there are a lot of companies. I just bought a stock of a sales tax accounting public company, which is doing great in terms of growth because of all the e-commerce sales, but they're still not profitable, especially on a GAAP basis. They're still not profitable after several years, even after they've been public for a year now or two. And then you see a lot of public companies that are not yet profitable, Uber and some others, that they just aren't there. So it all depends. Now, obviously, if you've got a good enough plan and a good enough business model, and you've got the right sort of management team and all the rest, you can keep getting investors that are going to carry you forward for a long period of time. You shouldn't go in believing that's going to happen, and you've got to go in with a plan. And I'd like to see you be profitable at some level. We'll talk through what that means, but to be profitable by the end of your second or third year at the worst. If your business plan shows that you're not going to be profitable for 5 years, I doubt the judges are going to put you at the top of the list. Okay. On the other hand, to be profitable within the first year, yeah, sure, some businesses could. If it's not one that's going to grow dramatically, where you've got to be investing in the people and the marketing programs and other things to reach that kind of level of revenue you want to get to, it's possible to be profitable in the first year. A retail store, a restaurant, something where you start out and you don't have an expanding level of costs. Sure, you could get there, but really doubtful for most of the businesses that have a long-term plan and a bigger value and are trying to reach out into expanding markets and so on. So again, I wish I could say by day 274 you're going to be profitable. No. That doesn't happen. It all depends on your model. But that model ought to be tied into what it's going to take to grow and how valuable you're going to be and stuff. So I'd say probably not in the first year, maybe towards the fourth quarter of first year if you've got that kind of business model, but certainly by the end of the second or almost certainly by third year, you ought to be able to say that you can start generating some amount of profit. Maybe not as much as you're going to eventually, but you ought to be able to show some level of profitability for sure. Okay, so again, we talked about, and I think I pressed the button and got to the next slide, but in this metric that we're talking about gross margins, just like it's going to change for you over time, in different industries, there's different levels of gross margin. Okay, software companies, ones with really high value products that don't have an ongoing big cost for each unit that they produce, they can have 80% gross profits. And a lot of the software companies and other pharmaceutical companies and things like that do have very high gross margins and stuff. Manufacturing, again, depends on the kind of quality of the product and how big it is or how much of a commodity product, but you can see a pretty big range in manufacturers from 20 to 60%, as I've said here. And then you get some others, whether it's retail, especially grocery stores, they survive not on the gross profit per unit, but just on selling a lot of products to people that walk in their door. And you can see, that they can make it with a 15% gross margin. So it all depends on your business model, the market you're competing in, but it's a way you can compare yourself and you can look at, what other established companies are getting, and there are sources of information for that. So, whoops, should have gone back. I didn't have that. So how far back did it stop?
It just
pretty
happened.
recently, yeah.
Yeah.
Okay.
I'm not sure why it cut out, but it says end live video.
Yeah, so it's still going.
Go ahead and pick it up and let's see if it carries up. Carries on here.
So continue. Okay. So again, in the sales and marketing area, we're talking about at least breaking it down between sales and marketing to get some budgets for what it's going to cost you for people, for expenses on creating those products or marketing programs and things. We're still going okay? Great.
That is great.
And then in general administrative, you've got accounting and finance, you've got legal, you've got human resources. You've got several different kind of departments within that general function, and you really need to start as soon as possible budgeting what your expenses are going to be in each of those areas. So, and then the type of expense, some of it's going to be your personnel costs, the people you hire, whether it's internal employees or outside independent contractors. If you hire a software development group, or when you first go in and you're not going to have your own internal, day one you're not going to have a chief financial officer or an accountant. You're going to get those services from outside until you grow big enough to need and afford both. So a real key, and start out again, just like Professor Valdez said before, even in the operating, and all your expenses, in operating expenses, some of those are going to be fixed. You're going to, you've got one president of the company. You don't need two presidents as you double in size and stuff. Others, they're going to be very variable depending on the kinds of things, whether it's a payroll processing cost or some others. So think about whether they're going to be fixed or variable. Most of them tend to be more fixed. That is, yes, they're going to grow, but they're not going to grow at the same rate that your revenue grows. And that's what's key, because over time you want revenue to grow faster than operating expenses, so that gross margin drops straight to the bottom line, as it's called, the operating income or operating margin after operating expenses. So you'll see that, but again, they can't be fixed totally. As you grow, you've just got to add on more. You've got to have more people collecting your receivables. You've just got more people in administration and things like that. So again, you'll see it in the model. You'll be able to use it. So once you've projected those, then take each of them. Certainly each of the main three functions that we talked about: R&D, sales and marketing, G&A, and show those as a percentage of revenue. Okay, and again, you'll see them not growing as fast as revenue, so that percentage of revenue will stay a little bit more fixed. It won't grow as fast. It'll actually come down as a percentage of revenue as your revenue grows faster. And it's a really easy, well, not easy, but it's another way that you can compare yourself, again, against private companies through SBDC info or in public companies, and just see what their percentages are of revenue in each of those functions, and a good way to compare your model against what other people are doing. And again, as we've said before, and as Professor Valdez said before, you're not going to be profitable day one. So yes, you're going to present, and yes, you're going to have some level of gross profit. That is, after your revenue less your cost of goods. We hope that's slightly positive, at least from the beginning, and improving over time. But you've just got to gear up. You've got to be ready. You've got to have a lot of expenses of things that you put together to be ready to go out and go after those markets that you're trying to get. And so early on, your operating expenses are going to be larger than your gross profit. You are going to lose money for some period of time. And that's expected in any kind of a business that you're really trying to grow something meaningfully. You should expect to lose money for some amount of time. Whether it's 3 or 4 quarters, like we were talking about before, or 2 or 3 years, that depends on a lot of different factors, and there's not, I can't give you a hard and fast a rule of thumb to employ, but you ought to just feel like you're, over time you ought to see progress towards getting profitable and some target for when you're going to achieve that. And again, lots of ways you can compare that with both public and private companies, so worth doing for sure. Okay, so there are some items, and again, by the way we're doing it, we're not trying to be GAAP compliant. We're trying to understand whether we've got a doable and potentially successful business model. So some of the things that you'll typically see on a P&L from an in-place company are interest, taxes, depreciation, that is the expenses, expending over a period of time of equipment or other capital assets that you buy. Those we're going to ignore because what we're trying to come up with is not how much, we're not trying to come up with your capital plan. We're not trying to come up with those. We're going to look at those separately, your capital assets. We're going to look at the cash requirement to do that. We're not going to try to blend them in to the profit and loss statement. And again, the Beta Alpha Psi advisors will be able to help you, comprehend and work through those for sure. But it simplifies the whole process because, what you're trying to come up with is not, the really, final answer you're trying to come up with is how much capital, how much financing, whether it's debt or equity, do I need to really get this company launched, scaled up, and turned into a profitable, positive cash flow business. So those are the key elements we're trying to get to. So what you're then talking about in your operating profit number is just what we talked about, earnings, operating earnings before, that's what the B is, interest, taxes, depreciation, and amortization. That's really, so it's, you're starting out again with revenue, taking out your cost of sales, getting gross profit, taking out your operating expenses, and that gets you to this measure of operating income, which we're calling EBITDA. It really is that sense of how much cash is my business model creating out of normal everyday operations and stuff. So before financing, before capital expenses, yes, like we said before, it's going to be negative for a while, but you're going to trend towards positive and have, in the foreseeable future, whether it's a year or 2 years or 3 years, you're going to have a path to getting to positive EBITDA. So it is a very widely used number. You'll see in most kind of financial websites, whether it's Yahoo or Morningstar, or whether you're reading business news and you see that company A just bought company B and they paid a number that was 12 times or 10 times or 8 times EBITDA. So that's the value of a company, whether it's what they paid or what the company is worth, and you'll find that in a lot of places. So it's used by your bankers. You go to a banker and they're going to say, well, we'll lend you some amount, but the total debt outstanding can't be more than 2 times or 2.5 times your EBITDA. So it's a number you'll hear that a lot in your business career. This term EBITDA. That's how it's pronounced, by the way, EBITDA. I see it. Others pronouncing it different ways, but that's the normal way to pronounce it. And you'll get to use that term a lot in your careers. And again, what's good about it is that it doesn't factor in interest costs, so how much of your capital you've raised in debt. Taxes vary, depreciation varies across companies based on their capital needs. it's one of the most, it's not perfect, and you'll see it different. All the auto companies today, they have an EV to EBITDA of about 8 or 9 times, public companies. Whether it's Daimler-Benz or BMW or Toyota or Tesla's the one that doesn't. Tesla's way up there, totally overvalued in my opinion, but the major ones do. Software companies, though, they could be up 20 times EBITDA for a public company in that. So yes, it varies across industries, but within industries and even in comparing different industries, it's one of the most highly used numbers. So it's a good one. It's a good one to understand and to be able to see where you come out. And we'll talk about it at the end of this when we talk about valuing your company. So now we've sort of looked at the operating expenses, operating income, but there are a lot of other things that you're going to spend cash on. One of them is called work, and they're the assets. They're the things that are on your balance sheet that don't flow, immediately to your P&L. They're sort of there, and they use cash, and they some of them get on the balance sheet. On the profit and loss statement. Some don't. Working capital; those are assets and liabilities that tend to have less than a year of life. So either you're going to use them or collect them within 1 year. Current assets are things you're going to spend money on. So if it's inventory, clearly you've got to have inventory on the shelf if you're going to sell a product. That requires cash to put it on. Okay, it doesn't go into the P&L right away, but it's a cash requirement. If you give your customers time to pay, if you give them 30 days to pay, where does that money come from? You've booked it as a sale. You've said, I've got that profit, but I haven't collected yet. So I've got to have cash to cover that until my customer pays and stuff. So those are things that, and again, you can forecast them. They're harder to forecast at first because you're just learning about your customers. You're not sure exactly how your inventory is going to move, how it's going to sell. You've probably got to get a bigger order relative to your revenue at first, just because your suppliers aren't willing to make smaller orders for you. You've just got to get a minimum order size, so it's going to take longer to move that off the shelf. So things change over time. They'll start leveling out as you grow, but they require cash and you're going to need them. The current liabilities are things you owe people within a year. Typically, it's your accounts payable. When you order inventory, they'll give you a little bit of time to pay, not as much as as you'd like to have, and certainly you'll get better terms as you grow, and they understand your willingness and ability to pay for that. But so that's actually, it's almost like a supplier has lent you money because they've given you product and they've given you 30 days to pay. So that actually reduces your cash requirement and it sort of offsets some of the others. So you'll go through this and you'll come up with those, and we really focus on prepaids. You'll see in some other, more established companies, we're not going to worry about that. You're going to book your expenses if you have to pay rent a year in advance, or you buy an insurance policy for a year. It's when you book that and actually pay it that it'll hit that. You're not going to smooth those out. So you're going to do that. We've got some formulas for coming up with your accounts receivable. If you give people 30 days to pay, and they're probably going to take 45 days if you give them 30, but you take that 45 days and you divide it by 360, and that's a percentage of your revenue that's going to be tied up in receivables. And again, as revenue grows, so is that amount you've got tied up in receivables, right? And you've got to find a way to fund that while you're waiting for your customers to pay. So that's a cash requirement. The model helps you do that. You put in your terms, and it'll help you, it will calculate for you the amount of working capital required.
So Mr. Masner, now I'm sure Beta Alpha Psi will help set, the accounts receivable and accounts payable. But what type of guidance would you put for the students in terms of the number of days they should put in their model? I think historically we've said 30 days, both for accounts receivable and accounts payable. Would you say that would be like kind of a good starting point, or do you think that they should maybe put another different number in there?
It depends on the product you're selling. It depends on the competitive environment, what competitors are offering. Depends on the difference in power, negotiating power between you and your customers.
Okay.
You know, you sell to big companies, you ought to convince them that, gee, I'm a small company, I really need you to pay me on time. I might even give you a 2% discount for paying within 30 days. But it's really up to them, okay? And you see that happening all the time. If you're selling another kind of product, you could be selling totally with credit cards payments immediately, and therefore you have no receivables. You just pay the 2 to 3% processing cost for the payment. So again, it's unfortunately there's no hard and fast rule. It depends on the kind of product. It depends on what customers are typically used to paying for this kind of a product. You're probably not going to get them to pay a lot faster unless, again, if you're going out to big customers and they really see the need, they really want to work with you, they want to establish a relationship, you can convince them that that you need money, you need cash flow a lot more than they do. They've got a lot more sources of it than you do, and you really try to convince them to pay you quickly. But again, it's really hard to forecast that ahead of time. I'd be very conservative and say, when we're selling to big companies, we really expect 40 to 45 days of payment. So again, all depends on who your customer is, what type of payment and terms they're used to paying for your kind of product.
And I think also that for me, when we started this conversation, really at the very beginning when we were talking with Beta Alpha Psi, prepping for today's workshop, you really hammer home the importance of cash flow. I know because I've worked with you for many years, for you, cash flow is king. And I think that, when students are going through and they're coming up with, their costs and they're modeling their profits, this is going to play a big role in terms of your cash flow. Totally. Because if individuals, your customers are not paying you in time, your numbers may look fantastic on paper, but your cash flow, because they're not paying you, may be negative, and that's how you run yourself out of business. And so I think it's going to be really important that the participants understand that all these documents are really important. They all tell different things, and they all have different messages on what you need to do for your business.
Exactly. Totally agree.
Okay, good.
And it's one thing for receivables. Inventory is the next one. Okay, and it's again very difficult, especially if you got multiple products. You're not sure how much they're going to sell in what order, how quickly. You might have different colors, different sizes, whatever.
Sure.
And so early on, your inventory, you're going to have a lot of inventory sitting on the shelf relative to what you're selling. Over time, you'll understand what sells best. You'll tune your ordering process to sales. You'll better be able to forecast some things. But early on, you're going to have some pretty big inventory requirements in terms of the cash required to get it on the shelf so you're able to sell it. So you're just going to have to work through those again. Be conservative. You'll improve things over time in terms of inventory turns or how much you got. So again, I'd say when you're looking, I sort of try to recommend to people when they've got a product that they're selling that early on you talk about having 90 days worth of sales on the shelves. Okay. Could you be better than that? Could you prove it that it's going to get better quickly? Maybe. But, in just 90 days, 3 months worth of product sitting on the shelf sounds like a lot. But again, it probably takes you a long time to order. You're not sure you want inventory on the shelf. So if you do get orders, you can fulfill those orders, not disappoint customers that are going to not feel very good when you can't get them when you can't get them something in ordering. So at least 90 days you ought to start with. And then, over time, again, as you get into subsequent years, you'll be able to turn those faster, but you're almost always going to have something pretty close to 60 or 90 days in terms of inventory on the shelves to be able to meet your customer demands and stuff. So, and again, though, the cost is not the revenue that you sell it at, because it's the cost to get it on the shelf. That's your cost of goods sold. So that's why we always multiply this 90 days over 360, that's 25% of revenue, and then multiply that times your cost of goods, and that'll tell you how much cash it's going to take to get that inventory on your shelf. And then, again, payables, you can subtract that using the same thing as the opposite of receivables. How long do you get to pay times, the cost of goods that you're paying for outside, materials, any other things that you're buying. So that helps you a little bit. Again, suppliers, they want to be confident. They want to know that you're going to pay for them. You're going to pay what you buy from them. So they're probably not going to give you great terms at first. Some of them I've seen that it's cash on delivery, COD. I'll show up with my truck. You give me the check or the credit card, and I'll unload it and stuff. So and again, that depends on how unique it is, what you're ordering, and what the competition is of suppliers for you and things like that. But you can't be overly optimistic that they're going to give you a long time to pay in the early stages. So again, there aren't any hard and fast rules. It depends on the kind of business, the kind of venture you're trying to come up with here. But you can think it through, and you can come up with these numbers and show what kind of cash is required, again, for net working capital. It's current assets minus current liabilities, and tells you what you need. The next one then are the fixed assets that you're buying. So fixed assets are ones that are typically above a certain amount of money. They sort of say $1,000 is kind of the minimum. Anything less than that, you expense it. More than that, and having a life of more than a year, you put it on your balance sheet as an asset, and then you tie the expense in, the depreciation life, 5 years, 7 years, 10 years, 39 years for a building, whatever it is, you take that capital asset cost and you spread it out on your P&L as depreciation. We're not worried about that. We're not going to try and depreciate and put it on the P&L. We're going to say, you go out and you buy 5 computers or 10 desks for your employees, that cash is right there. It's required. You've got to have a way to fund it and stuff. So we're simply looking at the cash impact of buying these capital expenditures. Again, within that, break it down by the same sort of way that you are breaking down your operating expenses. So if you've got 5 computers for marketing and this and that, break it down by function. So you're really seeing what you're spending for each of those functions. And then even within the function, break it down by the category. Is it production equipment? Is it computers? Is it furniture? Whatever it is, just put that in, give that label to that line in the model, and have some assumptions for what it's going to cost, and then put it in there. And of course, you're going to have to, if it's going to have freight that costs to get it in, the sales tax, and then what's it going to cost to install it, especially if it's production equipment and stuff, to get it up and operating. So include all of those costs, because you're going to pay those costs. So include that in what the cost of the asset is. And then again, your cash is king. Cash flow is king. You want to minimize your cash requirements. So if you can rent, don't buy, right? Eventually it'll be, it'll cost you more early on in terms of per something cost, but renting it requires less cash outflow up front than buying it. So rent it if you can, buy it when you're cash flow positive.
Hawk Tank leaders, please listen to Mr. Masner on this one. I cannot tell you the number of Hawk Tank teams I've seen where they want to buy a building. They want to, I don't know, spend millions of dollars up front because they think they need it. And our mentors, Mr. Masner, myself, we always try to talk you out of it. Because before you commit that type of resources, you really want to make sure you perfect your business model, because that's a lot of cash to be churning through if you don't need it. So please heed Mr. Masner's warning on this one.
And again, you'll pay a little more to rent something than you would to buy it in that sense of over time. But, if you buy it, where's that money coming from? You're going to a bank, or, and they're probably not, they might lend it to you if you're buying a fixed asset. Are you going to investors? Believe me, they will charge you a lot for using that money to buy something, you really don't need it. So again, you're trying to minimize the cash required, the capital required, whether it's debt or equity financing. You're trying to minimize that amount while you scale up your business and spend it on things about really achieving greater market penetration and stuff. So conserve your cash, rent, don't buy wherever possible. Including people, by the way. It's the same thing we talked about before. You know, you're not going to hire a full-time chief financial officer or even a full-time bookkeeper in the first 6 months. You're going to rent those services from an accounting firm or a CFO for hire firm. You're not going to bring in 16 software developers and put them on your payroll. You're going to go outside and use one of the existing development companies, and you're really renting their services in that sense for developing your software. So wherever possible, minimize the cash that you've got to invest to build your company until you're positive cash flow. Then you can make those decisions. Okay, now I've got enough cash. It maybe makes more sense to buy versus rents. Okay, so again, in each of these, you're going to be saying, okay, in the first 4 quarters, here's how much I've got to spend to purchase these assets. Then after that, each year, maybe your production, the equipment that you buy in that first year is going to last you for 2 years of revenue, 2 years of production. Then you've got to add some more. So you're just going to think about that, think about what's going to look like over that 5-year process or 5-year period. So when you combine all these things, you come up with what is really the key number in any business, and that's called the free cash flow. So that's what cash you need in the early days, and then and then in the end, it's the cash that's being provided by your operations. Your operating profit less what you need to fund the growth of the company in terms of working capital and or capital expenditures. What's left after that? And that's, at some point, you're going to be negative for the first several periods, whether it's quarters or a few years. And that's the cash burn where you're negative cash flow. You've got to get cash flow positive at some point because there's not an endless supply of capital. And that cash burn period, the cumulative amount of that, is what you've got to raise from either loans or equity financings to really fund that period of growth and scaling up of your business. So it's a really key number. It is the most important number. You hear even public companies, they start, it's a really positive event when they turn cash flow positive. So we heard Netflix in their last earnings report say, we really think we can be cash flow positive next year. When Tesla went cash flow positive, Elon had a party and stuff. And Uber is still not there yet. They've got a ways to go, which just is surprising to me. But, it's a really huge event when it happens because now you're no longer dependent on raising additional capital. Now you've got free cash flow that you can use, in some cases, to pay back the capital you've already raised, and if you've borrowed loans, or to start repaying your shareholders with some return. But it's a really key event. The sooner you get there, the better. And the sooner you get there means, again, you haven't raised capital which costs you, whether it's part of the ownership of the company if it's equity, or certainly pretty significant interest rate if it's debt financing. So that's what you're really trying to get to. And again, this negative, the cumulative amount, because if you're 4 quarters in a row, if you've got negative cash flow each of those quarters, it adds up to whatever that is, year 2, year 3, whatever. That total amount, the cumulative amount of negative cash flow, that's what you've got to raise in terms of debt or equity. That's where you've got to come up with your capital financing plan to say, I really think I can do that through some combo. And typically, it depends, but it's kind of hard to get bank loans. When you're a pure startup, you're going to probably have to rely on some sort of capital stock equity financing. So it's the big number. It's the end result of all of this. And again, The more you can minimize the cash burn, the more you can bring it in and stuff, the better off you are. And when you raise it, you know, it's you'll hear the term, what's our runway? You know, you've got a certain cash burn, you've got a certain amount of capital that you've raised. How long is it going to last? And that's really a key thing.
So we have a question for you, Mr. Masner, from Dee. So she's looking for a little more clarification on what is working capital and why keep it low. Is the way she understood it. And
okay.
She just said she apologized, but there's no apology necessary.
Yeah, no.
So let's do some clarification. So what is working capital?
Okay. So again, a GAAP, generally accepted accounting principles. When you have assets that you have and liabilities, so assets are things you own and have paid for somehow. Liabilities are things that you owe, you haven't yet paid for, but you're going to have to someday. A bank loan, accounts payable to a supplier is a liability. So a balance sheet has assets and liabilities, and essentially what everybody uses, and it's a GAAP principle, is any asset that you expect to sell or get rid of within a year, or any liability you pay off within a year, those are called current assets and current liabilities. And the net of those two is called working capital. So you've got some current assets, you've got some current liabilities, and the net of those two, which is a cash requirement that you've got to find a way to fund, that's called working capital. And current liabilities are working capital, and the net of the two is net working capital. So again, it's kind of interesting. A restaurant, for example, has negative net working capital. That is, you know, they buy, whether it's wine or food or other things they buy, and they get terms, maybe it's only 2 or 3 weeks or a month, but they get terms to buy that stuff from their suppliers. They collect right off, you know, you pay when you consume the meal, so they actually have their current liabilities are bigger than their current assets. That's good because, you know, you don't have to put up as much cash. If you're a business that's producing product and you got to have it on the shelf, and you give your customers terms to pay, you know, you've got to find a way to fund those terms provided to your customers and the inventory on the shelf, and that's going to be bigger than your current liabilities that offset that. So your net working capital is going to be big, and you've got to find a way to fund it. It takes cash. Every asset you put on your balance sheet, whether it's again a customer receivable or inventory, you've got to fund that somehow. You've got to come up with the cash to fund that, and that's why you want to try to keep it as low as possible. But you know, there's only a certain amount of control you have over that if you're, you know, again, meeting customer demand and customer expectations for payments and things. So that's what net working capital is. Fixed assets, the same, or long-term liabilities. You can call them long-term assets. Nobody really calls them that. They call them fixed assets. But fixed assets are ones that last for more than a year. Long-term liabilities are ones that you won't pay off totally within a year, like a 5-year bank loan, for instance. So those just go, you know, on a different section of the balance sheet. So you've got current assets on top, fixed assets. You've got current liabilities, long-term, and the net of those two things is the equity of the company, the net worth of the company. So that's, and again, all of those things require all the assets that you put on your balance sheet. You've got to come up with cash or find a way to fund them, and so you want to keep them as low as possible. Okay. Hope that answered the question.
Yeah, I think I did, Mr. Masner. And I think the thing to understand, Dee, is the working capital is the capital you need to run your business, right? To buy those inputs, to create those products. Ideally, and Mr. Masner was talking about this, it'd be great to have other people pay for that while you kind of make your items and then sell it, get the cash, and then pay back what you have for those inputs. And that's what we're talking about, that whole accounts, the accounts payable, where like Mr. Masner gave the restaurant, where restaurants do not pay for their produce or for their steaks or for their chicken the day it's delivered, right? They actually get 2 or 3 weeks to do something with that food, to sell it, to get the capital necessary to pay for it. And so with Mr. Masner's example, there's an opportunity for restaurants to actually have negative working capital. What that means is that they have these liabilities from their suppliers, the napkins, the glassware, the food products, and they're given time to make it back, and it's negative because it's someone else's dime paying for it. And that's what Mr. Masner is talking. If you can find someone else to front load you and let you make money from it, that's great. And that's what he's talking about, trying to keep it low. It's different for every industry. It may not be possible, but that's what he's trying to kind of really guide you towards, is those opportunities to let you make money on other people's money.
Exactly. And again, it has to do with, it has to do when you put out cash, where does it show up? So if you're paying your employees or buying something that you pay for immediately and you put it on the balance sheet, on the P&L because it's an expense that we talked about before, that's where you show it. If there are other things that don't get there, that is, they don't show up on the P&L, but you need them to be in business like we've just talked about, whether it's inventory or receivables or then offset by payables, those things require cash. They go on your balance sheet. You've got to account for those because they require cash, and you want to, again, everything you do, you want to minimize the cash that goes out, maximize the cash coming in the door, minimize the cash going out the door. That's the definition of a successful business. So that's what it is. And again, I understand for people that haven't taken accounting and finance courses, this is a big jump forward to try to understand this stuff. Work through with the Beta Alpha Psi advisors, work through with other things. You'll see some, read this again, read the slides again, and you'll see when you start doing the model, you'll see some of that. And I think it'll be clearer, and you'll understand, you'll really see the impact of being able to manage inventory, receivables, and other working capital. Okay, so again, free cash flow is EBITDA less the growth you have for this working capital, the current assets and current liabilities, less your capital expenditures, that is the fixed assets. That's your free cash flow. That total number of negative free cash flow, that's what you're going to have to find a way to finance. And that really determines, how successful you're going to be. Is there a way to raise that amount of capital that you need to fund the business until it turns cash flow positive, until it's self-sustaining, standing on its own because it's cash flow positive. So now we get a thing that all of you are probably interested in. Well, what's the value of what I'm building? Okay, and we're gonna, there has to be some sort of a format for kind of trying to come up with that everybody uses somewhat consistently, and that's what we're trying to do here. So what we're trying to do, which we talked about before, is taking some multiple of your EBITDA, some multiple of your operating earnings, but with some of these other factors that we've been talking about through this process of this session, and putting a multiple on that on your year 5. So, there's no sense doing it in the years. You're saying, in 5 years, I can build a business worth this much money. So you're going to look at your 5th year EBITDA, and you're going to try to come up with a multiple of that. And what we've used here is 4 to 8, which is pretty reasonable for most private company sales. Now, obviously you get a higher multiple if you're out there and you go public someday and all the rest, but public companies, they have a certain multiple of EBITDA, and they don't like to pay as much as their multiple because they want to buy things cheaper that they bring in and essentially get the markup for having bought that. So you see that over and over again, that typically public companies, when they buy private companies, will pay about half of the multiple of EBITDA that they're getting in the public markets and things. So we're using 4 to 8. To get to the top of that range, to get to 8 times, you've got to have some very specific attractive characteristics of your business that get you there. So first one is, do you have some proprietary intellectual property or some other sustainable competitive advantage that is, that's going to allow you to sort of keep competition at bay for at least some amount of time? Can anybody keep it at bay forever? Well, no. If you've got a patent, 17 years, yes. But that's about the longest they can possibly get. And typically, people find a way around patents in less than that time. But you really, if you've got some competitive advantage, some proprietary intellectual property, whether it's a great trademark at minimum or some great thing, but patentable things. Patentable things. Then, hang on, I apologize. I went the wrong direction. Okay. So that's one really a valuable characteristic. The second one is how fast you're growing, right? You're going to pay more for something that's growing faster than something that's growing slowly or not at all, right? That just makes sense. So the higher your revenue growth is, the higher your multiple of EBITDA is going to be. And we've said that even by year 5, you should be growing at least 25% to get up towards the top of the multiple. And we'll show you a table that helps you get those determinations for what it means. Recurring revenue is always valued by buyers or investors more than one-off revenue. So if you've got a recurring revenue stream, Netflix is the perfect example, right? You pay whatever it is these days. You even lose track. That's people talk about that all the time. I think I pay $14.99 a month or something. I don't even know. You lose track of it. But every month they collect that. They don't have to come out and sell me. They don't have to get me advised about their product. They don't have to sell me every month. They don't have to incur additional costs to get me to be a customer to try the product. Once they get me hooked up, and it's sticky in a lot of ways. Often, if you sell a software product that gets integrated into a company or a government entity, those things tend to stay in place for a long, long time. Netflix things do. Magazine subscriptions do. Cable television, all those, a lot of cutting, of course. But all of those kinds of things where it's recurring revenue, where you're not out having to find new customers for every new chunk of revenue. It just repeats itself over and over. People pay a lot more for that kind of revenue than they do the one-off product sales. So that helps increase your multiple. High EBITDA to revenue margins is key, right? If you're making 50% EBITDA margin for every new dollar of revenue versus 10%, that's obviously worth a lot more, right? So you're going to get a much higher EBITDA multiple for that kind of business, and you see it even within the public companies. I mentioned a car business that I talked about, even a Mercedes-Benz, 8 times EBITDA. Well, it's because, sure, there's some stickiness. Once you buy a Mercedes, you're probably going to have more likely to stick with it, but they've still got to get you to sell every new car. Every new car you buy, they've still got to get you to do that as frequently as possible. There's costs of that. So they're not, but, you look at a Netflix, that's an absurd level to multiple of EBITDA, but, other businesses, you can see 15 times EBITDA for recurring revenue models, for sure. And then the last one is the capital efficiency. So it's, again, whether it's working capital or fixed asset capital, if you're growing, and every time you grow, you got to build a new plant, you got to get more equipment, you've got to spend more money to grow, then you're just not as attractive. So again, if you can be very capital efficient, that your total capital requirement for a doubling of your revenue is only going to cost you an additional 20% of your capital base to add equipment and add receivables and things like that, then you're a lot more attractive to a buyer, and you're going to have a higher EBITDA multiple. So those are the key things. Again, we're using the 5th year out EBITDA to get to a thing. So you'll see in your you'll actually see, let me go back, you'll see in the model itself that for every one of those factors, you put a chunk of EBITDA multiple, depending on where you sort of come out on that scale, some of them are automatic from your projections you make. Others you have to add in, and you'll come up with a model, with a number that says, I expect, that we're believing that we can get someplace between a 4 and 8 times EBITDA multiple for our 5th year EBITDA. So what you ought to be able then to say in the end of all of this is that we believe that we're highly confident that with X amount dollars of financing, your cumulative net cash burn, so with X dollars saying we can build a business worth this many dollars in 5 years. That's the net. So that's where you end up. Now, once you've done all that, there's a little bit more you actually can take and put all this into income statements, balance sheets, cash flows, and you'd want to do that to some extent, but for the competition, you don't need to. You're going to say, this is my total cash, my cash flow, here's what I need, here's what I'm going to be able to build in terms of value. That's the end result of, showing whether you've got a viable model or not. If you don't meet those, if you're at the low end of all of those characteristics, the EBITDA multiple characteristics that we talked about, if you're down, you come out in the 3 or 4, you can get below 4 in this thing, then you've really got a question, do I have a viable model here or not? Or if it's going to take you, tons of capital, to raise tons of capital to get there, you've got to say, is my business model enchanting enough? Is it going to pull people in, potential investors that they're willing to provide that amount of capital they need? So again, that's all dependent on your product, your business model, what you're going after, and in the end, essentially your value proposition that's the center of the whole process. So, okay, we're good to go on then?
That's
okay,
awesome.
well then, that's the end of this financial projection.
Perfect.
In terms of introducing it to you.
I know.
You've got a lot of work to do now to fill out these models, and the next step is trying to get some help from really talented people that understand this and can help you through the process.
Well, thank you, Mr. Masner, so much. We really appreciate it. So here's where we're going from here, y'all. Number one, Dee asked about the slides. What I'm going to do is I will send the slides to all the team leaders, and so you'll all receive the slides for sure. We also are putting together a packet of all the slides that have been sent out, as well as any supplemental information. So as registered team leaders, you'll be receiving that also. The next step in tonight's workshop is we're going to all migrate over to this Zoom meeting ID. I'll also put it in the chat, the URL. And what we're asking for you, if you're looking for a Beta Alpha Psi consultant, then what we'll do is we'll go to Zoom. We'll hopefully hear more about your idea, more about sort of what your needs are, and then we'll have a Beta Alpha Psi member connect with you and help you, once again, take your idea to the next level. So let me, before I say goodbye, I want to send this message. Okay. And so I just sent the message. It actually has the actual URL for Zoom. We'll be on there in the next couple minutes or so. And so once again, I want to thank you all for attending tonight's Hawk Tank workshop. I want to thank Mr. Masner from Scape. And also we're coming to you live from historic Durango at Fort Lewis College's Center for Innovation. So thank you all, and we'll see you all on Zoom. Have a great evening.